Hello, I hope this finds you well. Today is Friday, August 14th, 2015, and in less than 5 minutes, I will share with you some highlights from the markets and the economy last month, as well as some key indicators we will be paying attention to moving forward. So let's jump right in, starting with the economy. The trend so far this year in the US has been that economic growth continues despite some very challenging global bumps along the road. In July, we did get the first look at Q2 gross domestic product, or GDP, which came in at a 2.3% annualized growth rate. It was a little bit below consensus expectations of 2.5%, but I do want to point out that we also got substantial revisions to Q1 GDP's numbers. I should say substantial revisions up from 0.2% to 0.6%. Other broad measures of economic activity came in generally upbeat last month as well. The leading economic index, which we talk about a lot, or the LEI, was up 5.5% year over year, a number that is historically associated with an only 5% chance that we will go back into a recession in the next year, as compared to a 15% chance at a random date. The U.S. economy also added a solid 223,000 jobs for the month of June, and the unemployment rate ticked down a little bit to 5.3%. Over in Stockland, commodity declines hit the energy and materials sector and weighed very heavily on emerging markets. Here in the U.S., the S&P 500 had a pretty solid month, up 2.1%, but the markets the entire month vacillated between, on one hand, concerns out of Greece and China and commodity declines, and on the other, improved confidence and fundamentals as we started to see the bulk of Q2 earnings start to come in. The S&P 500 hit a low on July 8th, which was still only a 4% pullback roughly from the all-time highs that the S&P hit on May 21st of 2015. Year to date, the best performing sector is the healthcare sector, and the worst performing sector, as you can imagine, is the energy sector. In international markets, China and Greece dominated headline risk. In China, their A shares fell over 30% in less than a month between June 12th and July 8th of 2015, as measured by the Shanghai Composite. Overall, the Msci Emerging Markets Index had a very tough month with losses of nearly 7%. Performance in international developed markets, as measured by the Msci EFA Index, pretty much mirrored what we saw here in the US with the S&P 500, up 2.1% for the month. In bond world, interest rates fell amid growth concerns, so we saw the 10-year Treasury yield fall from 2.4% at the beginning of July to 2.2% at the end of July. The overall bond market, as measured by the Barclays aggregate, was up 0.7% for the month. The yield curve did flatten a bit, with long-term rates falling while short-term rates rose. The July Fed meeting reiterated the Fed's plans to increase interest rates later in 2015, although I will mention the recent news that we got out of China, the surprise news of them devaluating their currency, could change our plans here in the US, so we will be keeping a close eye on the Fed and their policies, of course, moving forward. The other thing that we're going to be paying attention to is the rest of Q2 earnings season. So far this earnings season, we have seen some resilience here in the US in terms of American corporations and their profits, and we've seen some positive surprises ex the energy sector, so it will be interesting to see if that trend continues moving forward. As always, if you have any questions, please feel free to give me a call. Thank you so much for taking the time to watch this, and I wish you all a great rest of your summer.